Hey everyone, welcome back to the channel. It's Tuesday, April 14th, 2026. There's an interesting divergence playing out right now between different market voices and our own systems. Tom Lee was on CNBC recently and stated that he believes the bottom is in. He pointed to the fact that even as the Iran war worsened and oil rose last week, stocks stopped going down, which he sees as a constructive precondition. He expects stocks to head back toward all-time highs and possibly reach his 2026 target of around 7,300 on the S&P 500. However, our Elliott Wave analysis is still showing that Wave C of the current corrective phase needs to take place. From that perspective, we cannot yet say the bottom is definitively in. Wave C is typically the most impulsive and sharpest part of a corrective move, so our count suggests more downside, or at least a completed Wave C, is still required before a sustainable new uptrend can begin. This creates a clear tension. Tom Lee's view is more bullish in the near term, expecting a relatively quick recovery. Our Elliott Wave count requires Wave C to complete first, which aligns with the possibility of additional downside pressure in the coming weeks. Our time and timing system continues to flag June through August as the highest probability window for the sharpest decline of the year. This suggests that even if a short-term bottom forms soon, the more significant decline could still lie ahead in the summer months. So how are we actually playing this in the project? We are taking some profit on any positions that are in the green during this bounce, especially if we approach new all-time highs. At the same time, we are holding the bulk of our long-term positions. If the bottom is in, great. We take some profits at all-time highs and let the winners run. If the bottom is not in, we wait patiently and will look to buy depending on clear system signals as the decline unfolds. The key is having a plan ready regardless of what happens. That way we stay disciplined instead of reacting emotionally to every move. This layered signal fits well with the broader 2026 project outlook. Q2 remains the highest caution zone, with rising inflation forecasts into Q4 adding pressure and complicating the new Fed chair transition. Q3 could see stagflation-like pressures peak. Q4 still offers the best window for potential recovery once the mid-year risks are worked through. Our base case remains a roughly 20% correction sometime after the new Fed chair arrives, but before Q4. The overarching project principle is clear. Risk management comes first. Stay diversified across sectors and geographies, hedge volatility when multiple signals align, and practice patience during these below ADH grinds that make up 85 to 93% of market time. Having Tom Lee calling for a bottom while our Elliott Wave count still requires Wave C is a perfect example of why we don't rely on any single voice or system. We let the different frameworks speak for themselves and look for confluence or divergence to guide our decisions. What do you think? Do you lean more toward Tom Lee's bottom is in view, or do you agree with the Elliott Wave count that Wave C still needs to play out? Drop your thoughts in the comments. If this balanced look at the differing signals helped your market exploration, hit like, subscribe, and turn on notifications so you don't miss the next one. Thanks for watching. Stay patient, stay prepared, and I'll see you in the next video.